Hello, and welcome to Chapter 3. Now, Chapter 3 is a really big chapter, so you're going to see this actually broken out to Chapter 3A and Chapter 3B. Chapter 3A is going to get us through the actual adjusting process, which we take the journal entries like we learned in Chapter 2, and a few of them we actually have to adjust to their actual amounts. Now, before we get into all that, we're going to get you into two bases of accounting. One is known as the cash basis of accounting. And this is basically when we recognize revenues and expenses when cash is actually received or paid. So when we lose that cash asset, like we saw with Chapter 1 and a lot with Chapter 2 itself, that's when people recognize that. You mostly see this a lot with small businesses. Or if you want to take it to board game realm, Monopoly. You lose cash, you gain cash. But for our sakes, this is not consistent with GAAP, because GAAP has those two basically principles of revenue recognition and expense recognition. So we follow into what is known as the accrual basis of accounting, which basically again is when revenue and expenses are truly earned. So we're not going to be dealing with the cash basis, we're going to be only dealing with the accrual. Now again, this is dealing with mostly a matching concept, which means for every revenue we actually recognize or earned, there should be expenses tied along with it. Now, this is what we're going to be using, and the accrual basis really only has the accounts receivable and accounts payable. Cash basis will not. So if you actually see financial statements and they're reporting the year and they don't have those, then they're probably on cash basis. If they do have accounts receivable and accounts payable, they're on their accrual basis. Mostly any company that's on the SEC exchange will be the accrual basis. It is part of GAAP, it is part of the SEC, so you will see them all on that kind of basis. So again, here's a nice little graphic. I love the graphics. Enjoy them. It brings out something good. So our main entry, because we're on the accrual basis, we do have to sometimes adjust accounts. These accounts are really, they're not at their correct amount that we physically have for the most part. So we have to adjust them at the end of the period. Usually the period's end of the fiscal year, sometimes the end of the month, but it will always really truly just change to accounts. These accounts are going to at least have to be one balance sheet account right here. So I would again highlight this, big old highlight. It must have at least one balance sheet and one income statement account. If it doesn't have one of each, the adjusting entry is not right. So when we get through these, you have to watch out for that. Okay? Always make sure, again, one balance sheet, one income statement. Also, a big thing, and I will tell you, I will make sure you get more points counting off if you ever do cash. Cash is never affected by adjusting entry. Never, ever, ever. Okay? So don't use cash for your balance sheet entry. It will always be like supplies or prepaids. It's mostly going to do a lot of prepaids. So, for our purposes, cash is never. There's only a rare chance that cash is affected, and that is basically when cash needs to be corrected for an error. We're not going to deal with that. So cash is never affected. So again, from chapter 2, we had to deal with the trial balance, the unadjusted one. So right here, this is probably going to be familiar with you if you looked at the notes for chapter 2 or the video, and realize that the numbers are still the same. We do have certain accounts, some accounts have 0, but now we're going to go from the unadjusted to the adjusted. Nice. So, first account that we deal with is known as supplies. Supplies is considered a prepaid account. So again, most of these are going to be prepaid accounts. With supplies is a physical item. So we can actually go at the end of the year and count how much supplies do we have, or how much inventory we have on hand. So from our trial balance, we are currently showing that supplies are $9,720. But Mr. John Doe came along and actually counted our supplies of red staplers and paper and pencils and whatnot, and found out that we only have 8,670 left. So this doesn't add up. We only have this, but we're saying we have this. This is where we have to do an adjusted entry. We must require to show the use of supplies. So basically we're going to take the difference between 9,720 and 8,670 is 1,050. That's the difference. That's the amount that we've used during the year. Again, used. So with that, we have to create a journal entry, and it's going to use supplies expense for that amount. You're going to notice a lot of the sister accounts for these adjusting entries, especially when it's an asset, is going to be expense, and with the name. So supplies expense, supplies. Since we used the supplies, I like this T-chart right here. Since we used the supplies, we have the supplies right here, the amount that we used, the beginning, and the ending. So for these accounts, we will only have the beginning and ending. So you must subtract those out to find the actual adjusting part, the missing link, what made it down to the ending value. Notice this is recognizing the same T-charts that we did in chapter 2, but we have to fill in this blank. And notice also it has ADJ. ADJ just stands for adjusting. Okay? So with this, since this is making supplies go down, to make it to this amount, it must be a credit, since supplies is naturally debit, since again it is an asset. So the debit part, if you see from the journal entry, is to supplies expense. Again, remember, all expenses are debits. Okay? So from here, that is it for supplies. Now again, this chapter alone is a tough chapter. So if you've got any questions at all, just let me know, and I'll be more than happy to try and explain a little bit further for you. Okay? So going to our next one, prepaid insurance. Prepaid insurance, again, is going to affect the same way as supplies. Now, with prepaids, they're a little bit easier to kind of figure out. So we're going to assume that Net Solutions bought a 2-year insurance policy for $24,000. So 2 years for $24,000. On December 1st, 2017. So for 2017, they only had it for December, so only 1 month of the year. So at the end, it only used up 1/24 of the insurance policy, or technically $100. Now, since we know this is a 2-year, and if you want to, you can take the 2-year. Now, I believe I have the journal entry actually hidden here. So here's the journal entry. But if I take the 2-year, and we know 2 years is 24 months, and we're working with just 24 months, we can take the amount and actually just divide it by 24. This is how we get 100 per month. So if somehow we know that we've depreciated for a full year, that's basically half, so that's 12,000. But since we're only going for 1 month, this is where we get. You can also take, if you figure out each month, that's where you can say if this insurance policy was for 6 months that we used up in 1 year, we can just take the per month times by 6, and it would have been 600. So this one, with all prepaids, it's just looking at the time, and I will always suggest probably divide it into months. It helps out a whole lot easier. Okay, so with this, first off, we have our prepaid insurance. Again, all prepaids have some type of time with it. And then again, its sister account is insurance expense. And notice it's just for that 1 month. 100, 100. So prepaid insurance, again, here's the T-chart of it, which is again awesome. Remember, it starts out at 2,400 because it was a debit for that amount. We used up 100 of it for December, and we should have an ending balance of 2,300. Again, when you see these problems, you're only going to see the beginning, what we actually bought it for, and the ending. Sometimes we don't even get the ending, especially with the prepaids. It just tells us what the time frame was. But for every debit, there must be a credit. So again, every debit, credit. Every credit, debit. So insurance expense will be debit for that 1 month that we actually used. Now, accrued revenues. Accrued revenues is a little bit more fun. It is when services are performed, but we have yet to bill the customer. We're just doing it, and we're probably going to bill them after we've completed the job. Well, due to the percentage that has been completed, and due to GAAP, we must recognize the revenue still. So, because it has been earned. And since it has been earned, we're going to assume for fast forward, again, we're going to use 1,800 in services in December, and we just have not billed them yet. So, with that, we're going to do the good old journal entry that we've been done with actually billing the customer. Just in the real world, we just haven't billed them yet. So, with this one, we will take the accounts receivable, we'll raise it by 1,800, just because we still are going to receive that cash from that customer. Again, we just haven't billed it yet. And we have to recognize the revenue of fees earned. Again, all revenue is either earned, income, or revenue itself, except for sales. So, with the journal entry, notice that this is still going the same route. So, accounts receivable at the end of the period, that records the unbilled of 1,800. Notice it has been adjusted right here. and our balance is just $1,800. We didn't have any other journal entries at this time. This again goes along with our trial balance. So if you would like to keep going up here for the trial balance, you can definitely check out and see what the beginning amounts were. Down here, consulting revenue gets the credit of that $1,800 that we recognize. It already had an amount in there when we just recognized the complete balance, $7,850. Always add up your sides to get your ending total. Next one, we have accrued salaries. Now, accrued salaries does take a little bit more math to actually figure out. This is mostly when we actually are going to pay an employee their regular paycheck, but it falls just outside December 31st, or the ending year, whatever fiscal year they use. So with this, we just have to calculate the following days that we have during that payroll cycle, and basically say we owe our employee this amount, but we don't pay them till after the 31st. And since with the revenue recognition and expense recognition, we still have to recognize the expense of paying that employee. Now, we're going to recognize that basically our employee, he gets a basic salary, because we're going to use salary. Wages are done the same. They're just a little bit more complicated because we have hourly, and we don't actually know the hours until December 31st. So that one we actually have to do a little bit later. In fact, we're not going to really go into much of an hourly wage, just with salaries. So with that being said, again, our employee, he makes about $70 per day, which is awesome. He gets $350 for a 5-day work week. Okay, he's our only employee, so that makes life easy. Well, on Wednesday, we actually have December 31st. So we actually owe him 3 days work of salary for the previous year, but he doesn't get paid until Friday. So GAAP tells us we still have to recognize that expense. We can't roll it over into the next year. So we're going to take the 3 days, which is Monday, Tuesday, Wednesday, and times it by what he makes per day, which is $70, which gives us a good old total of $210. Rock on! And thus, we then have to record the adjusting entry. Now, since we owe, again, keyword is owe our employee this amount, it is known as an adjusting entry and a liability. So this is a salaries payable. Again, keyword pay. So we owe our employee this amount. And of course, it's going to use that sister account of expense. This time it's just salaries expense for the 210. So again, you can also do wages expense, wages payable right now. Either account works perfectly fine. Sometimes Connect will throw either one at you. And also with these, anytime that we have where we're going to actually pay them the full amount, we do have to do a reversing entry. The reversing entry itself is an adjusting entry. It's only known as reverse. Whoa. Because we're going to take it from the expense and the repayable, because it's going to record exactly the way it's supposed to be for the full check. So after the beginning of next year, So usually on January 2nd, or whenever the payroll period goes, we didn't flip this original account. So depending if you use wages or salaries. And basically it's a complete flip, and this is why it's known as reverse. We reverse what we did. Don't worry too much about this part because we're not going to get really too much into this. We just want to know how to actually accrue a salary. Okay? The next part is known as unearned revenue or deferred. Remember, we kind of briefly gone over it in chapter 1 and chapter 2 when this account actually popped up of what this account is. Again, this account is basically when a client has paid us for, basically prepaid us for services we have yet to do. So again, we have the accrued revenues right here. This is for stuff we've done but not yet billed. Right here is for stuff we have been paid for but not have done yet. So we haven't earned this amount. This is why the keyword unearned is. Now, the thing with unearned, once we actually have earned the amounts, we can recognize as revenue. In fact, the SEC and the IRS says, according to GAAP, you're back into that same, hey, you've earned this amount from your unearned, and you must recognize it. This one's a little bit tricky, so granted, please check the homework and keep an eye on this. So with this, we're going to follow again about 3 steps. One, we have the first one, which is fast forward's client paid a 60-day fee in advance covering the period of 12/27 through February 24th. And thus we recorded the proper entry. We received the cash on December 26th, and we have yet done the service, so we have unearned consulting revenue. So again, this is the correct journal entry for an unearned. Well, fast forward actually earns payment as time passes. In fact, by December 31st, it has actually earned 5 days worth. So we're going to do the simple math of taking 5 days divided by the 60-day fee and times by the amount of cash that we have received. So 5 divided by 60 times 3,000 equals to 250. So that 250 right there, this cool 250, is the amount that we've earned in, let's just make it simple, 2017 going to 2018. So for 2017 we earned the 250. We still have 2,750 left. So we need to actually adjust this entry, because if we don't do any work into the next year, we still owe the client that amount of basically deposit for us to do the work. So, but we get to keep 250 because we've earned the 250. So this is going to be our revenue. Now, look where it is right now. It's in unearned. We're not dealing with cash. We did not receive cash. We only did unearned. So since this is becoming now revenue, we're going to have this little journal entry right here. We're going to take the unearned consulting. Now, for this, it does say fees, but you can put revenue. Again, both of these are basically running the same thing. So this is our liability account. Now, since liabilities are natural credit, this is going down by the 250. Since we've earned 250 of this, it must be debited. Our fees earned, our consulting revenue, will increase by that 250 because again we've earned that amount. Now, with fixed assets, this is a big adjusting entry that we're going to actually get into more later in the course, because fixed assets is a big issue and you need to know what they are. Best other account that you actually hear this is from is known as Property, Plant, and Equipment, or PPE. And basically, fixed assets are any assets that have a long lifespan. They're going to basically last longer than a year. So, a few examples, of course, is land, building, equipment, machinery, vehicles. You think anything that you can physically touch, but is going to last for more than a year. Cash, you can physically touch, but are you going to keep that for a whole year? No, you're going to be spending that a lot. Same thing with inventory. You're not planning to keep it for a whole year or more than a year, longer time. But so, since fixed assets actually get to be there for many moons, many years, we have to do something per the IRS and per GAAP known as depreciation. Since buildings, equipment, machinery, vehicles, they don't last forever. They do wear down, they do end up basically decreasing, and we know this from anytime you hear, oh, you just bought a new car. Well, guess what? As soon as you drive off the lot, it has lost half its value. It's not actually true, but you do lose some value as soon as you take off with it, and that's known as depreciation. The only one that does not depreciate is land itself, because land is going to be there no matter what. We can go on 100 years, land is still going to be there. Even if it's underwater, the land is there. A building, if you try and keep that same building for 100 years, more likely it has deteriorated to a point where it has to be knocked down and redone. Same thing with equipment and so forth. So anything that you know that's going to basically break down or going to need to be repurposed, stuff like that, that is going to be a fixed asset. So for us, we're going to do a simple depreciation. This is going to be known as straight line. When we get in later in the book, you're going to actually see two other methods that can be used for different other items. But for our purposes in Chapter 3, it's all about straight line. So we're going to use this example. Fast forward, purchased equipment on December 1st for $26,000. It actually has an estimated useful life of 60 months. And the equipment is expected to be worth about $8,000 at the end of 5 years. They purchased the equipment on December 1st, but it is now December 31st. Okay, so a lot of things right there. First off, if you notice again, we're only dealing with 1 month. We buy on December 1st, December 31st rolls around, we get depreciated for 1 month. The formula that we actually use for this is the cost. And again, whatever it costs us to actually get the product and get use for ready to actually be used in production, that's our cost. And then we subtract the residual value. Residual value just means what we think it is going to be worth after its lifespan. So for them, they think it's going to be worth about $8,000. Its salvage is $8,000. And then we must divide it by expected life. Now, since we're using months, we can actually use the 60. Most of the time, we do use years. So roughly this is 5 years. So basically we can use years or months, but since we're only having 1 month actually in this example, month is better for us. So again, just like everything else, this will have an account known as depreciation expense. Oh, and it's going to have a new account known as accumulated depreciation. This is its credit account. Now, we do not touch the equipment, the buildings, or any of the fixed assets. For all depreciation, these are the two accounts you're going to use. Depreciation expense is always going to be your debit for the amount of depreciation there is, and accumulated depreciation will always be your credit. So, with that, the accumulated depreciation itself is an actual asset account. With that, as you can see, it naturally increases by a credit, which makes it known as a contra asset, because it doesn't use the actual real balance that normally happens with an asset. Remember, assets normally increase by debit. This is one of the few that actually only increases by credit. The other one is accumulated amortization, which we'll get into a little bit in just a sec. You'll also know another term right here, known as book value. Book value is basically the cost of the item minus accumulated depreciation. So if we actually took the $26,000 that we did to purchase minus its accumulated depreciation of $300 for the year, you're going to be looking at $25,700 as its book value. Again, we're going to get into more of this later on. We're going to get you the basic knowledge of this, and then once we hit fixed assets, long-term assets later on, we'll get in more into detail. But really know that it is considered a contra asset account. So once we've done these journal entries, so all these journal entries up here, we get to finally do what is known as an adjusted trial balance. So with this, after everything's been posted, all those adjusting entries, we get this little trial balance, and you're going to notice that it looks a lot similar to our unadjusted right here. And then we actually have our adjustments right here itself. And notice what the adjusting, you see these little letters like F, F, B, B. Notice that they're the same amount except debit and credit. These little letters right here, they help us identify which journal entry was used. Okay. Again, accountants, we like paper trails. We want to make sure if anybody looks at this, that they can see what exact adjustment has actually happened. Now notice, when you look at consulting revenue, notice it has two adjustments that happen to it. These both get added up, and that's why we got 5,800 to 7,850, because both of these add up to that. Okay, so again, we can actually look at here and see what happened. Like if I match up the D's, I can see unearned revenue, consulting revenue got used, so I know we earned that from the 3,000. RF, accounts receivable, we have money that we haven't yet to bill. So again, knowing these and seeing these is just another way to understand what has happened in the process of our accounting cycle. So again, we have our adjusted trial balance right here. and this is going to be the total of everything. So again, we have an adjusted cash. So cash comes over here. Accounts receivable started at 0, has 1,800. We should have 1,800. Again, you can verify these with your T charts. Okay, T accounts, which I would always suggest with adjusting entries, have the T accounts ready. It helps out in the end. But you're going to notice usually the income statement side of the trial balance, starting from revenue and working way down, will always have the most accounts that have been added. Again, if I look from that one to the original, so all the way up here to the original, notice that there's a lot of expenses missing. We only have 3. And if I go all the way back down here, and we have more than 3 now. So when we add one, we must put in the 0 here to show that it hasn't been, there was no account for unadjusted, and then adjusting has to have it. Okay. So to finish up 3A, we have the profit margin. Now this ratio right here is basically seeing how well the company's sales are to its income. Are they becoming profitable? So the big thing is here, you don't want to see a negative number. Negative number definitely means there's no profit, so we wouldn't actually use the ratio itself. But you want to see at the end of the day, after expenses have been subtracted out from net income, how much of sales do we actually get to keep per year? So we're using, as you see from this example right here, limited brands. If we took its net income and divide by net sales, you notice in 2011, we won't start with this one, was 8.4% compared to our industry, because this is where investors will look at, especially if it's like on yahoo.com where I can easily check out the finance section. And if it's beating out the industry pretty good, one may question a little bit, because if it's really high compared to the industry, they may not be telling the whole truth, or they are actually hitting out the water, which would cause me to invest. As you can see, they have beaten out the industry every year by almost 5%, 6% some years. And we can actually tell how well has the company gone. So they have been doing great on the profit. Right here, 8.4% and 9.1% right here of an actual profit. Now again, the numbers are small, so it really does affect a little bit more, but basically know the ratio, profit margin, net income over net sales. Again, accountants, we love to use these profit margins just to basically get a somewhat understanding of how the business is doing itself. A lot of times you're going to use these for audits, but if you're just trying to find a valuation of a business, it's good to know these ratios. Okay, so here's our practice problem, because we all love practice problems. Yay! So again, we're going to take our unadjusted trial balance right here. In fact, I want to minimize this just a little bit. So we got Big Jim, Big Joe's brother, consulting service. We got Big Jim and Big Joe. Yeah, both big. Going on. But they have an adjusted trial balance for the month ending December 31st, 2017. Now, notice again, trial balance is staying at its date just like before, and this is the unadjusted. So of course, we're going to have to do adjusting entries. So we're going to journalize the following adjusting entries required on December 31st and add new accounts if needed. First thing that we have to see is supplies on hand at December 31st was $100. So we did a physical count and we found out we have $100. Well, this says we started out with 1,780. Now watch out for these accounts and what they say, because again, this is only telling me that at the end of the year I had this, not that this is the adjusting entry. So won't let me do it. Let me see if I can do our little calculation text box. Actually, I'll do it here to explain. So with our journal entry, again, it's all about supplies expense and supplies. Again, notice that it's 1,680. The reason right here is that the supplies started off at the 1780 one, but on hand, or at the end of the period, we only had 100 left. So the difference between those two tells me we used up 1,680. So since we used that up, or we basically, used it, there's not another term to really go with it, but since we basically paid the supplies, maybe that, people take it, people stole it, who cares, we only have 100 left, that will be our expense of the 1,680. 9 times out of 10 with anything physical like this one, it will tell you the ending balance and not the adjusting entry. Always watch out for that. Okay. B states prepaid insurance at December 31st is 1,800. Prepaid insurance right here is 4,800. Again, we're going to use December 31st. And we have our prepaid and we have our insurance expense. Now, since this journal entry actually tells me that we ended up with 1,800, we can take the 4,800, subtract our ending balance of 1,800, and that's why we got 3,000. We actually used 3,000 of prepaid insurance. Our 3,000 of that insurance policy has expired for the year. Okay. Depreciation for the equipment for the year is 1,000. Alright. So depreciation, again, probably one of the more easier journal entries if it flat out gives it to us, is still depreciation expense, accumulated depreciation, and since it gives us this, we don't have to figure it out, just a good old $1,000. Yay! Easiest journal entry right now, till we actually have to calculate. D, we have accrued salaries at the end of the year, 900. Again, you can actually check if you remember the journal entries. If you don't see them here, it probably helps us out a little bit. So, accrued, again, salaries expense, salaries payable because we owe that amount, we haven't paid it. So treat it like a bill. And again, it tells us the amount right here. We don't have to calculate whose ever salary it is. It's right here. Cool little thing. Accrued revenue, again, 1,800. Again, we're not calculating anything. We just haven't billed our client. So our journal entry, again, is going to be accounts receivable because the client owes us of 1,800. And we have to recognize the revenue of $1,800. The last journal entry we have, the balance is unearned rent at the end of the year was $1,600. Again, watch the wording. It's telling me the balance, or the ending balance, is $1,600. Let's see what we have in unearned rent. We have a whopping $6,000. So just like these right here, we must subtract between the two. So journal entry, again, is unearned rent is going debit since we're decreasing it, and rent revenue is going to go up by that amount. So the math between here, we take our unearned rent of $6,000, subtract out the $1,400 ending. Was it 14? No, it's 16. Sorry, $1,600 of ending, and that gives us the $4,400 that was actually earned during the year. So again, only a few accounts are getting adjusted right now, and so as long as you can pace yourself and learn which accounts get adjusted and how they do, that's half the battle. Okay, so at least knowing the accounts themselves helps you out, and then working on how we get the amounts. I would probably suggest how to study for this chapter, especially 3A. 3B with the closing entries is just a little tad bit easier, I'll tell you that. But that is it for chapter 3A. Let me know if you have any questions, and I'll get back with you with chapter 3B, closing entries and finishing up the closing cycle.